Hello there. Welcome to Accounting Grade 10. Today we want to look at a question from a question paper. This question paper is for Limpopo province and it's a provincial common test. We can go down to see other details according to this test, a grade 10 test, and it's for accounting term 1, task 2, controlled test number 1 for 17 March 2023. So this is what we have, and we want to look at the first question on that question paper, and this is the question that we have, which is question number 1 on that question paper. And the first part of this question paper is reading. It has 5 marks a year, and also it requires us to spend 4 minutes on that question, and it is 5 marks. So the question reads: choose the correct words from column A to match description in column B. Write only the letter A to E in column B next to the question numbers, and then that's 1.1 to 1.5 in the answer book. For example, 1.5, and then you write the letter on the front of the number, which is F here. So this is the example that you are given. So we are going to enter as it is, right? So the first term that we have there on 1.1 is double entry principle. So we are going to look for the description that is matching double entry principle, but double entry principle on its own describes the double effect that is there on a transaction. Remember, when a transaction takes place in a business, when it's recorded in the books of accounts, it's recorded twice. So this is the double that is here. And when it's recorded twice, we record it in those T accounts. We debit the transaction in one of the accounts, and we credit the transaction in the other account. Remember, every transaction affects 2 different accounts. So one of the accounts must be debited and the other one must be credited. So we cannot have a situation whereby we debit and debit or credit and credit. So what it means is every debit entry has a corresponding credit entry. And when we start by crediting, we say every credit entry has a corresponding debit entry. So that's what happens in terms of double entry. So this principle describes that concept of debiting one account and then you make a corresponding entry of crediting the other. So if you look at the description that we have there, you go to D. For every debit, there must be a corresponding credit. So this becomes our answer. So we have got D is our answer for 1.1. So we can go to our answer book and write D is our first answer there. We have got D. So D is our answer. Then we go to the next term that we have there. Entity rule. Entity rule. Right. Entity rule on its own separates the activities that happens on the side of the owner and the activities that we see happening in the business. Remember, the owner owns the business, but what we are saying on the entity rule, we are saying we should separate the owner from the business. So it says, the entity rule says the transactions associated with the business must be separately recorded from those of its owners. So we should record the transactions of the business separately from the owner. That's the entity rule. It also says business must be accounted for and treated as a separate entity from its owner. So the separation should be there in terms of the owner and the business. So if you go to our descriptions that we are given there, if you go to F, let's go to see the explanation that we have on F. The explanation that we have on F is saying the owner pays a personal cell phone account with a business online banking app and does not record the amount as an expense to the business. The owner pays a personal cell phone account with a business online banking app and does not record the amount as an expense to the business. Yes, this is for personal use. The owner is paid for personal cell phone. These are private expenses of the owner, and they should be not recorded as a part of the expenses because they are drawings. Whenever we see the owner taking the resources of the business and using for private use, we regard them as drawings. And drawings also on its own explains the concept of or reinforces the concept of entity rule. So here it's correct that the owner is not recorded this personal cell phone expenses as part of the business expenses. The owner is complying with the entity rule. So you see that F is the most appropriate that we have there in terms of 1.2. So we can go there to the other section again, and on 1.2 we have F. Right, so that's what we have. Then move on to 1.3. On 1.3, we are told about duplicate invoice. We are told about duplicate invoice, but duplicate invoice on its own, it's when a business receives an invoice more than once with slight differences, such as maybe you might have differences of invoice number, dates, amounts, or even invoice description. But basically, the concept is that when a business receives more than one invoice, so what happens is the seller, when the seller sells goods, sells goods on credit to the buyer. There the seller is selling on credit, so there is an invoice which is issued as a source document. Remember, when goods are sold on cash, we have got a receipt as a source document being issued. But when they are sold on credit, an invoice is issued as a source document. So in this case of duplicate invoice, it means the buyer is going to receive two invoices. And then we are from the explanation that I gave is that maybe the second invoice might come in the form of maybe the collections that are there in terms of the date, even the amount, even the invoice number, or even the description maybe of the goods that have been sold. So that's what we have in terms of a duplicate invoice. So the explanations in terms of the description that we are given there, you would see that E is the most appropriate there in terms of a duplicate invoice. The document used to record goods sold on account. So whenever we are saying goods are sold on account, it means they are sold on credit, like what I was trying to explain there. So we've got E in terms of 1.3. So we go to 1.3 there, 1.3 there, and then we are going to put our E here. So this is our 1.3. Then we go to 1.4. Then on 1.4, we have got owner's equity. But owner's equity on its own, we regard the owner's equity as the resources introduced by the owner of the business in the business. Whenever the owner of the business puts resources in the business for the operations of the business, we call it owner's equity. And owner's equity can also overlap to the sense of the profit that is being made by the business when it's retained in the operations of the business. We also call it owner's equity, whereby it's coming in the form of retained earnings. So that's owner's equity. So on the description that we have there, we have B giving us the most appropriate explanation there, sources of earnings to the business. So 1.4 we have B. So we can go there and put our B there. So that's what we have. Then we go to 1.5. We can go and check again. We have got the prudence concepts. On 1.5, we have the prudence concept. But basically, the prudence concept explains that we should not overstate profits. We should not overstate profits. That's the main emphasis. And it makes sure that assets and income are not overstated. And also, it makes sure that provision is made for all known expenses and losses. It helps also the stakeholders to take an informed financial decision and predict the future prospects of the business. So basically, the emphasis is on making provision on all known expenses, all expenses that we can see that we are going to incur them. There's a probability of incurring them. We should make a provision as early as possible so that profits are not overstated. So that's the explanation that we have in terms of prudence. So in terms of the descriptions that we are given there, you'd see that A is the most appropriate there. It's reading a debtor who owes 1,270 rands was written off as a bad debt as he could not be traced. So we are seeing that this is an expense, that a probable expense that we are seeing, that this debtor, remember a debtor is someone who sold goods to on credit as a business, and then this person is owing us money, and we are seeing that the person may not pay back the money back, maybe due to different reasons. Maybe the person has left the country, the person has become bankrupt, has no money. So those scenarios, we can see that maybe we might not get our money back. So we make a provision in the sense that we create what we call a bad debt. So when you create a bad debt, it becomes an expense. We charge it in the income statement under operating expenses, and it's going to reduce the figure for our profit, and we are not overstating profits when we make that adjustment. So this is what we have in terms of prudence. So it means 1.5, the most appropriate that we have there is A. So here we have got our A for 1.5. So that's what we have for the first part of the question. We can move on to the second part of this question. Like, this is the second part of this. This is the question 2. It has 35 marks. Requires us to spend 28 minutes on this question. And we are going to go item by item and try to explain what we are supposed to do. So the question reads, use the following information from the books of Mikateko traders to analyze the given transaction according to the format provided in the answer book. So we are given an example of the owner took cash worth 400 rands from the business bank account for year-old use. So what does it mean? It means this owner is taken for year-old use. So this is private use again. These are the drawings that we're explaining. So it means here we've got drawings as one of the accounts. And then what has been taken is cash. So drawings and cash are the accounts that are being affected there. We have cash, the owner took cash worth 400 rands for the business bank account for your own use. So we have got cash and bank being affected there. So it means we can have the example that we are given there. We have drawings here, and then here it's not trading inventory, it's cash. We have got our cash being taken. So we've got cash crediting cash, debits our drawings, and we account credited is cash. And also we have to take note that the cash, the drawings account is only debited whenever we have got drawings. We are going to debit that account. Whenever we see that we one of the two accounts is drawings, we have to. So it means in this example that you are given, we are seeing that the cash that was taken from the bank account. So what is being affected here is the bank account. So it means in the example there they made a mistake there by crediting a trade here. Initially they had credited the trade inventory, which is not correct. We can just maybe cancel this and put bank. It's supposed to be bank, not because this money has been taken from the bank account. So this pre-entered trading inventory is a mistake. We are supposed to credit bank. So that's what we have in terms of the example that we are given. Then we go to the ones that we are supposed to put in that answer sheet. We have 2.1 is the first one, which is saying received 1,000 rands from Bank, a monthly interest on fixed deposit. So a fixed deposit, when we have got interest on fixed deposit, this is income. Whenever we see interest on fixed deposits, we got it as income. And we know that all income expenses, we can come here and try to put some explanations in terms of whenever we have income expenses. So whenever you've got income accounts are always, we always credit them. They are credited. And then when we have expense accounts, we are supposed to debit them. So these are the normal entries that we make in terms of income accounts and expense account. And here we are saying interest on fixed deposit is an income. So it means we are supposed to credit it. And then this interest is being received. If you go to the received 1,000 from Bank, a monthly interest, and we are going to see that this interest is going to be deposited in our bank account as a business. So what is going to be debited is the bank. We are going to debit this bank, and then we credit the interest on fixed deposit, and this is our interest on income. So we just create an interest on fixed deposit account and then a bank account. So those are the two accounts that we have. So we go there and end up as it is, as we are interpreting them in that first, which is 2.1. So we go to 2.1 here. So what we are saying is the account that is going to be debited, because we are receiving interest on fixed deposit, we are saying is a what? It's an income. So we are receiving. So what is going to be debited is bank. And obviously what we are supposed to credit there is interest on fixed deposit. So you can just say interest on fixed deposit. So this is the one that we are crediting. Then in terms of affecting assets, equity, and liability, remember this is an accounting equation. This is an accounting equation, and we need to actually know how it is presented. This accounting equation is presented as assets is equals to equity plus liabilities. So this side of assets, so we have got a demarcation that we have here. So this side should be equal, which means the total for assets should be equal to the total of equity plus liabilities. So this side should be equal to this side. So that's what we have there. So any transaction that is going to increase assets, when it's affecting assets and equity, it means when it increases assets, it's a plus on assets, it's also a plus on equity. If it's affecting assets and the equity. And if it's affecting assets and liabilities, again, the same applies. If it increases assets, it's going to increase also liabilities. So the opposite is true. If it's reducing assets, it's also going to reduce our equity. And if it's affecting assets and liabilities, the liability also is going to see a reduction also. So we have got a positive relationship on what happens to this side and this side. So the issue is after making the adjustments, the total of this side should be equal to the total of this side. That's why we are seeing these movements. But when a transaction is affecting equity and liabilities, one of the accounts that we opened is affecting equity, the other account is affecting liabilities. It means we are going to see a negative relationship whereby we are saying if our equity, we are saying it's equity plus liabilities. So if our equity is a plus, it's increasing, it means we are going to see a reduction here. So if here is a plus, we see a minus there. So that's the scenario that we have. And when you see a plus for liabilities, it means here you are going to see a minus. So that this total of this side will come back to the same position and to be equal to the total for assets. So that's the issue that we have there in terms of this accounting equation. So you go back to our transaction that we have there. The transaction that we have is affecting bank. So you see that bank is an asset. Remember, these are resources of the business. They are part of assets. Specifically, they are current assets because they are going to stay for less than. We assume that they stay for less than a period of 1 year. So those that are going to stay for a period of more than 1 year, we call them non-current assets. So here, bank is affecting assets. And the interest on fixed deposit, remember, we adjust it in the income statement. When we get our gross profit, we add other income. When we say other income, that's where we put our interest on fixed deposit as one of the incomes. So it's going to increase our net profit. It's going to increase our net profit. And net profit affects equity. It's part of equity. When we make a net profit, it increases our equity. We add it to equity when it's net profit. But when it's net loss, we are going to see a reduction of equity to reduce the figure that we have for equity. So interest on fixed deposit affects net profit by increasing it. It increases the net profit as income. So when it increases the net profit, it means it's also going to increase our equity. So that's the issue that we have there. So we are going to see a plus in terms of assets, and then we also see a plus in terms of equity. So I will go and check the figure that we have there in terms of this transaction. We have got 1,000, so it's plus 1,000 for assets and a plus 1,000 for equity. So we come here and maybe indicate those ones. We've got a plus 1,000 under assets, and under equity also, we also have a plus 1,000. So this is the effect in terms of the accounting equation. Then you go there and look at the next transaction that we have. So you see that we are now on 2.2. 2.2 reads paid 15,400 rands to Equip Solutions for the purchase of equipment using the bank app. So we try to identify the two accounts that are being affected there. Remember, we are paying using bank. We are paying using bank. It means we have a bank account that is there. Obviously, we have a bank account, and then this is Equip solution, and we are purchasing equipment. So it means we are receiving equipment in the business, and it means this is our non-current asset. Equipment represents the non-current asset. We are receiving it. When we are receiving it means when we're receiving an asset, it means we also debit it. But we also have an equipment account. Equipment account is the other account that we are having there. Then we determine which one is going to be debited, which one to be credited. We are paying money through the bank, so money is going out of the bank. Whenever money is going out of the bank, we credit it, and then when we are receiving money in the bank, we debit it. So in this case, we are paying money is going out of business, so it means our bank is being credited, and then the one that we are receiving equipment, we are receiving it, we are debiting. So that's what we have. So we can just go and summarize that one on the first section. We have equipment. So here we have got 2.2. So we have got equipment here as being account debited. We have equipment, and then the account being credited. We have got the bank. We have our bank. So now we come to the account equation and see what equipment is affecting and what bank is affecting. So we start with equipment. Equipment is a non-current asset, so it comes under assets, and we are debiting it. Whenever we debit an asset, it's a plus. So we have a plus for equipment under assets. And then a bank also is an asset. We should take note of that. Bank is an asset also. And here we are crediting, and when we credit an asset, it's a minus. So we've got a plus for assets, and we also have a minus for assets. So you see that here, it's a plus and a minus, and then we can just check the figure. We check the figure that we have for that transaction. We have 15,400 that is there. So we are going to put that one. It means here we've got 15,400, and also it's a minus 15,400. So the transaction is affected assets only. So this adjustment will come back to the same position with a plus 15,400 and a minus 15,400. You see that 15,400 minus 15,400 come back to zero. The total of assets will remain equal to the total for equity plus liabilities. So this is what we have in terms of 2.2. Then we can move on to the next one. Let's try to check the next what we have in terms of 2.3 now. Paid 2,400 rands to Mika traders in settlement of the business account after receiving a 4% discount. So let's try to identify the two accounts that we have there on 2.3. We have got this account is being paid, settlement of business account in receiving. So we have got a bank account there, which is used to pay Mika traders. We've got a bank account, obviously. We've got a bank account that we have there. And then the other account that we are supposed to open is for Mika traders. And Mika traders, we are paying that Mika traders. And it means if we are paying Mika traders, it means Mika traders is our creditor. So we are paying our creditor. So it means we also have a what? We also have a creditors control. A creditors control, and specifically is for Mika traders. So here we are paying money. It means money is going out of the business. The bank account is giving. Money is going out. It's an outflow, so we credit. Then for Mika traders, remember before this amount of 2,400 was on the credit side since it's a creditor. Now we are paying them. We go to the opposite side to remove it. So we are now debiting the creditors control for Mika traders. So that's what we have there. We can just go and summarize that one on the answer section, and the amount that we are having is 2,400. So here it's now 2.3. So remember the account that we are debiting is for creditors control. Creditors control. And then we credit our bank. And remember, we are debiting. Let's start by bank. Bank is an asset, so we are crediting. Whenever we credit an asset, it's an outflow, it's a minus. So we have got a minus 2,400. And the other account is creditors control, and creditors are liabilities, specifically their current liabilities. And we are debiting. When we debit a liability, it's a minus, but when we credit a liability, it's a plus. So here we come under liabilities, and we are saying we are debiting, so it's a minus. So we also have a minus 2,400. So the concept that I was trying to explain, that if you have a minus for assets, it means on the other side also it becomes a minus. So that's exactly what we have adjusted there. Then we go on to the next one, which is 2.4. We are now on 2.4. Let's try to see the whole transaction. What does it explain? Right. We are now on 2.4. Right. 2.4 is saying issued a credit note of 540 rands to S. Makua for goods returned by a cost price 360. So we have two amounts that we have been given there: 540 for the credit note, and then at cost price 360. We initially sold these goods, and these goods went out of the business, and we sold them to S. Makua, and then S. Makua returned those goods to the business. So what it means, we have got to reverse those goods and reverse the initial double entry that we had done. So by reversing what we are supposed to do, firstly, remember these are returns. They are allowances that have been made. So it means we have to create a debtors allowance, whereby initially when we sold, we credited them in the in the debtors account. Now they are being returned. Now they are being retained. It means we are going to create a debtors allowance, whereby we are going to debit the debtors allowance, and then we credit the debtors control account. So the issue that we have here, we can just maybe present it in the form of a T account so that it becomes easier to understand. We are having a situation whereby initially when we sold these goods, they were on the we debited them in the we debited them in the debtors control. Debtors control there. Then now they are being retained. It means now we go to the opposite side and enter the amount on the opposite side to remove them as debtors, because these goods have been retained. So these people are no longer owing us money. So we are going to create a debtors control by crediting it there. And then we create what we call the debtors allowance account. Debtors allowance account. These are returns. This is almost, we can call it a returns account. This one, we can call it a returns account. So we can have a returns account here. So this is what we have, a returns account. So it means we are now crediting in the debtors control, and then we debit the debtors allowance here. So these are the two accounts that are being affected in terms of the amount that we used to that we sold the goods to the debtor. So here we come, we see that we have got the debtors control account and the debtors allowance account. So we can just come here and maybe do this. We have got the debtors control account and the debtors allowance. So for the debtors control, remember we credited it, so we are crediting it with what? With 540. Because when we sold them for 540. So when we are reversing them, we reverse them with the figure that we sold them with. Then this one we are debiting it with 540 also. But also we also have the issue of 360 here. Remember, when you sell goods, there's an issue of cost of sales. When you sell goods, the goods that we've sold, the cost of those goods that we've sold, we also enter them in our books of accounts. So we need to reverse that one again for cost of sales. So for cost of sales, initially when you sold the goods, for cost of sales, initially when we sold the goods, we entered the cost of sales on the debit side. We entered the cost of sales on the debit side there. Initially, when you sold these goods, the cost of sales figure was on the debit side of the cost of sales account. So now we are, these goods have been retained, so it means we have to reverse them. So we are going to, the correction now, entry that we are going to make, we are going to credit cost of sales. And then these goods are coming back into the business. It means they are going to increase the inventory that we have in the business. So we are also going to create a trading stock account. Trading stock account, whereby now we also debit the trading stock. Since these goods we sold them at first, they went out of the business. Now they've been retained, so we are going to keep them in the business now, and they increase the stock that we have. So we debit the trading stock account. So this is the entry or the double entry that we have in terms of the goods at cost when they are retained. So this is what we have. So let's just summarize the two entries that we have there. It means the first one, the first two accounts that we are going to have are there. We are going to have our debtors control. We are going to have our debtors control, and then our debtors control is going to be, this is our debtors control. We are going to credit it. We credit the debtors control, and then we have got debtors allowance. We debit it. And remember the figure that we are going to use there. Let's just recheck the figure. The figure is 540. 540. So we have 540 there. The figure is 540. Then the other double entry that we have there is for cost of sales. We have cost of sales. The second one, we have cost of sales. And we have also trading stock. So remember, for cost of sales, we credited here. So for cost of sales, we are crediting. And then for trading stock, we are debiting. And then the amount that we have, we can recheck the amount that we have at cost now. We are entering that one at cost. We are seeing that at cost is 360 at cost. So this is the figure that we are going to use there. So we come here, we have 360 there. 360. So these are the two double entries that we are going to have there in the answer section. So we can go just and summarize those ones. This is now 2.4. So it means for the first one, we are debiting the debtors allowance. So here we can write debtors allowance. Is the debtors allowance, and then we debit debtors allowance, and then we credit the debtors control. This one now is the debtors control, and then the amount that we are having there, the amount remember was 540, and this debtors allowance. This debtors allowance and debtors control. The debtors control is part of assets, and we are crediting. Whenever we credit an asset, it's a minus, so you're supposed to have a minus 540 here. And then the other one is a debtors allowance. Debtors allowance is adjusted in the income statement, whereby they are going to reduce the sales figure. And when they reduce the sales or revenue figure, it means they're also reducing the net profit. And when they reduce the net profit is also part of equity. So when net profit is being reduced, equity is also going to be reduced. So you also have a negative here, a minus 540. And then the other two accounts that we have the trading stock, whereby we are debiting trading stock, trading stock. Maybe we can just maybe present this in form of the two columns, the two rows that we are given there. Firstly, what we did was to debit the debtors allowance. So you can just write here, maybe in big letters, debtors allowance. And then we credited the debtors control. Debtors control, and this was the effect on the accounting equation. Then still on 2.4, we also debit the trading stock. Trading stock, and then we credit, we debit the trading stock, and then we credit the cost of sales. Then we see now what is being affected in terms of this one. Trading stock is part of assets, and we are debiting it. When you debit an asset, it's a plus. So we are going to have a plus 360. And then the other account is cost of sales, and cost of sales is part of equity, because cost of sales we adjust it in the trading account. The trading account is under the income statement. So when we credit the cost of sales, we are reducing the figure for cost of sales. And when we reduce the figure for cost of sales, it means our figure for our net profit is going to increase at the end. So this is what we have. So when our net profit increases, it means our equity also increases. So you have a plus 360 here again. So this is what we have in terms of 2.4. So we can go back there and check the next question that we have from 2.4. So we are now on 2.5. Let's check the next one is 2.5. Right, so we are now on 2.5, and 2.5 reads both trading stock from Goana suppliers for 8,000 rands on credit. So it means the two accounts that are going to be affected there, we have got trading stock is the one that we are buying, but we are buying it on credit. So it means when you're buying on credit, remember, we open the name of the business or the person that we are buying from. We are buying from Goana suppliers. So we are going to credit the Goana suppliers account. So we have got trading stock as one of the accounts, trading stock. And then we have got this one, which is Goana. And Goana is a creditor, because we are buying from Goana on credit. So creditors control also is going to be opened, which is creditors control specifically for Goana suppliers. So which one do we debit, which one do we credit? Trading stock we are receiving since we are buying, so we debit it. So and then we credit this one, which is the creditors control for Goana suppliers. So this is what we have, and then the amount that we have is 8,000. So we can just go and summarize that one. In the other section, here we are. So we are now on 2.5. On 2.5, remember we said we are debiting trading stock. And then we are creating the creditors control. Creditors control. My space is short there, but you are supposed to write it in full, that creditors control. Then the accounts that are being affected with trading stock is an asset, and we are debiting. When you debit an asset, it's a plus. So you've got a plus here, plus 8,000. The figure was 8,000. And then for creditors control, creditors, they are liabilities, current liabilities in particular. Then when you credit a liability, it's a plus again. So on liabilities, we are here plus 8,000. So that's what we have. So the next one is 2.6. So we can go back again to check what we have in terms of 2.6. 2.6 reads paid interest on the loan with the U Bank at an interest rate of 15% per annum for 4 months. The amount of the loan is 75,000 rand. So the interest that was paid is the 15% of 75,000, but this 15% is per annum. So it means you have to calculate it. The answer that you are going to get is per annum. Then you reduce it to what? To 4 months. So let's try to calculate the amount before we identify the accounts that we have there. It's 15%, it's 0.15 as a decimal. Then we multiply by 75,000 rands, or alternatively, you can just say 15 over 100, because it's 15%, and then we multiply by 75,000 rands. So this is how you can calculate that one. This is, so here you are going to get 11,250. But remember, we want only for 4 months, so we multiply by 4 over total number of months that we have in a year per annum is over 12. So let's try to calculate that one. We punch in our calculator. Obviously, this side it's not to confuse you, to be over 1, so that we are not it doesn't confuse you. So when you calculate it correctly, you are going to get 3,750. So this is for 4 months. This is the one that we need. And then I will go back now. We now have the amount. We go back now to check which one to be debited, which one, which 2 accounts are there. We paid interest. So you've got interest and loan as one of the accounts. So we have interest on loan as one of them. And then the other one, we are paying using a bank. So we've got bank account again. But this is an expense, so we are paying it. So it means the money is going out of the business. So when it's going out in credit, so we've got a credit here in terms of bank. Then our interest on loan is an expense, and all expenses, remember earlier I explained that all expenses are debited. So here we debit. So that's what we have. So and the amount that we are going to use, we have already calculated it here. It's going to be our 3,750. So we can go there and just summarize this one. So remember, here we are debiting interest on loan. We are debiting interest on loan. And then we are crediting bank. Then we see now how does it affect the accounting equation. Interest on loan is charged in the income statement. It reduces profit. So if it reduces profit, it means it's a minus on net profit. And anything that is going to lead to a minus on net profit is also going to lead to a minus on equity. So you've got a minus on equity here of 3,750, or that figure that we calculated. And then we also have bank. Bank is an asset, and whenever we credit an asset, it's a minus, remember. So it's also a minus 3,750. That's what we have. We can go and check the last one, which is 2.7. Now we have 2.7 there. 2.7 reads the owner team Mikateko invested 40,000 rands directly into the business bank account as a year additional capital contribution. So this one is very simple. Money has been invested 40,000. And remember, this is capital contribution. So automatically we've got a capital account that is there. Capital account, one of them. And then 40,000 has been directed into the business bank account. So we have got also a bank. We have also bank account that is there. And remember, money is going into the bank account, so it's a debit. Whenever money gets in the bank account, we debit. And then capital account is always credited whenever resources are introduced by the owner into the business, be it in the form of a non-current asset or a cash or a bank. We credit capital account. So, and debit the name of the account of the resource that has been introduced. So in this case, this is what we have, and the amount that we have is 40,000 here. So we can just go and summarize that one. We are debiting bank. So this is 2.7, we can put it here. We are debiting bank, and we are crediting capital. And the bank we are debiting, it's an asset. When you debit an asset, it's a plus. So we have a plus 40,000. And then it's capital. Capital is equity. Capital is equity. So we are crediting capital, and whenever you credit capital, it's a plus. When you credit equity and liabilities, it's a plus. So in this case, we have capital, which is part of equity. It's a plus. So we come here on equity, we say plus 40,000. So this is what we have, guys, in terms of this question on the accounting equation, and double entry also is part of this question. Thank you for listening. Those who have been subscribed, please subscribe and share. We are still coming with grade 10 accounting question papers, questions from question papers as we go. So please subscribe and share. We meet again in the next video. Stay tuned. We are coming. With that, I'm signing out.